Hello, viewers. Welcome back to the fourth and the last episode of the month with AKC Capital Financial podcast series. I'm your host Shweta, and with me we have AKC Capital founder and director Mr. Aditya K. Chopra. As we conclude this month's theme, smart saving and debt management, today's topic is mutual fund explained, investing without being an expert. Mutual funds sound complicated. They are not. Instead of 1 lakh people each trying to become a stock picking genius, they pool their money and hire one expert. That's a mutual fund. Let's simplify it in 2 minutes. Today we will simplify the mutual funds and understand why they have become one of the most popular investment option for the investors. Welcome Aditya.
Thank you.
And my question to you, what exactly is a mutual fund and how does it work?
Okay, so thanks Shweta. I think that's a very interesting question. I think mutual fund is the most common investment vehicle today for retail investors in India. So a mutual fund, in a very simple way, is a vehicle that pools in money from investors and into a fund, and that fund then invests in the market. And every mutual fund has a defined strategy, and to keep it simple, invests in both equities and fixed income instruments, or a combination of both. And when unit holders pool in their money, they typically are allotted units proportionate to the investment in the mutual fund. And in a very simple way, mutual fund has something called a NAV, which is a net asset value. And the current value of your portfolio is very simple. It is the number of units that you own into the current NAV, or the net asset value, which changes day to day depending on the market fluctuations. I think that's where I would keep it at it. But for our viewers, I think this is a very active investment vehicle today in India. We are seeing monthly inflows of almost 30,000 crores in mutual funds on a monthly basis. And like we said that people can use this to participate in the listed markets, both fixed income as well as equities.
So explain me, why not just pick stocks myself instead of paying to the fund manager?
Well, I think that's an interesting question. So I think the answer to lies in the statistical data and the way we look at this. So statistically, it is proven that roughly 87% of people who are so-called quote-unquote stock pickers, or follow a DIY approach and pick up stocks randomly on their own, tend to underperform the markets over a 10-year period, while at the same time 73% of mutual funds tend to beat inflation over a 5-year period. So I think that is an important part to look at, vis-a-vis picking up stock on your own, or going to a mutual fund which is a managed portfolio route, because they have the expertise to invest in the markets. To look at the opportunity cost here, so an average stock picker, or a person who is a DIY do-it-yourself approach, would invest 1 lakh at roughly 8% over a 10-year period, that money growing to 2.1 lakhs. At the same time, a fund would probably grow at 12% at the same period, and grow to around 3.1 lakhs, right? So the difference, which is roughly 1 lakh, is basically the cost of amateur stock picking, to put it in the right perspective.
Further, would like to understand how large is India's mutual fund industry today, and what does that tell us about investor behavior and confidence in mutual funds?
Right. So thanks for the question. So I think the answer lies into the numbers which were there in the past. So roughly in 2010, we were close to around 3.92 to 4 lakh crore in the total AUM, or assets under management, for the mutual fund industry. Today in 2026, end of 31st May 2026, we are close to 80 lakh crore. So you see that in 16 years, the industry has actually grown 20 times. Now, what it tells us is that this has come at the backdrop of consistent domestic inflows into the mutual fund industry. To give you a perspective, today the average monthly inflows in equity in mutual funds is around 30,000 crores per month, and that's a massive number, right? This shows that there's a huge retail investors who believe in this industry and putting the hard-earned savings to build long-term wealth. Secondly, this is also highlighted higher participation by domestic institutional investors. It's retail investors, banks, insurance companies which invest in this space. And today it's not surprising that domestic institutional investors also hold a higher share than foreign institutional investors of the Indian capital markets. So this has been as a result of immense faith and belief in the mutual fund industry. But from an overall participation perspective, I think India still has a long way to go, because statistically India's, as a percentage of household savings, we a very smaller proportion of the population invests in Indian capital markets. So that's a long way to catch up when you compare it to developed markets.
So that brings us to a final question of the episode. How do I actually start, and what is the minimum amount I need to start for SIP?
Well, I think, like I said earlier, mutual fund is a very basic form of investing and participating in the Indian capital markets. So the least you can start with is with an SIP of 500 rupees per month, because that's the bare minimum that you need to invest in any equity or any mutual fund per se. So I would suggest that start with an SIP of 5 rupees per month, and then one can scale it up gradually. And if you get that into that habit, then 500 rupees invested per month with a 12% CAGR return. Let's say you invested in an equity mutual fund, diversified equity mutual fund, over a 25 years period becomes roughly around 95 lakhs. And the good part is that anybody can start this. You don't need knowledge of stock markets, just the habit of making an early start and consistently continuing with the investments, because it's a compounding over the longer term which makes a difference. And like we said earlier in the series, that a mutual fund is a managed portfolio through which you are participating in the Indian capital markets, and hence you don't need any technical skill set or market knowledge to get started. So start now and begin the journey at the earliest. And we feel that today, with a larger population having access to bank accounts through initiatives of the government, you could contact your financial services provider, open an account, and start investing in the mutual funds, right? Or you can also consult a SEBI certified registered investment advisor or a wealth management firm or a distributor to help you in this journey. At the same time, you're seeing a proliferation of new age wealth tech firms today, which give easy access to set up your accounts online, and it has never been easier, because you can actually do that in a few seconds using Aadhaar based authentication. So the processes have become very simple. So start investing and start your SIP now, and take that jump, and happy investing.